So one thing about theory work is, it takes time to digest these models. So if you're seeing this for the first time, it's very natural you're completely confused. The point is to essentially, a lot of these models is to go over them multiple times and get very comfortable with them. I mean, it's just like learning a new language. But that's theory, right? It's the same thing with doing empirical work, right? You need to be very comfortable with the methodology and so on. So these models I'm talking, go back to the paper of Stein, read it. You'll get confused, but persist, read it, relate it to what I've done. And you'll see after 5, 6, 7, 8 times, eventually you'll see, it'll click. That's how it works, right? It works. When I took the theory class at Minnesota, I took the class probably 10 times. Oh, I'm exaggerating, maybe 3 or 4 times. And so I always tell a PhD student, you've taken a PhD class at wherever you are at, take the class again, take it again, because the second time you take it, you realize you sort of have a better sense of what was going on before. Third time, you are much more comfortable. Fourth time, you are really extracting what you should be extracting from that class. And even when you become a professor, you should actually sit in PhD classes at the school you're at. I think it's an important thing to do because you are still learning and developing and doing, So learning never stops. That's something I can realize in my old age. Now, learning never stops because actually over time you realize that you need to reinvent, rediscover yourself and keep pushing yourself because the world is changing very quickly and sometimes what you did in graduate school, you're like, oh, it just got me a job. Now I need to actually finally learn. It's true. Because you're so into your PhD, you say, oh, I need to get my job market paper. What do I work on? You find something, you work on it, it gets you a job. But then you look back, you're like, now, so what? What do I do now? Do I really want to do this? And so many times you actually say, no, I wish I want to do something completely different. But that's okay. Hopefully you go to a school that gives you that flexibility to experiment and find what you want to work on. All right, so let me now get back to the second or third model, I should say. So I did the generic model. I did the Stein model, right? So the message from the Stein model was consistent with the generic model, which is that information asymmetry, together with caring about prices or market-forming beliefs about future cash flows, these two assumptions taken together implies that decisions might be distorted, right? Disclosure or non-disclosure might have real effects. In the example of Stein, there was no accounting. But there was accounting in a very stark way, which is that B was not observable, right? When B is not observable, in a way you can think of it as some information cannot be credibly disclosed to market. Now I'm going to put a bit more structure on that. In the third model, I'm going to take you to a model of investment and accruals. Very, very basic model. And we'll see what happens when you don't measure something. What are the distortions? So the distortion will be very similar to what we saw in Stein. There'll be underinvestment. Though in Stein there was overinvestment, you'll see why, but we'll relate the two. Then question is, what happens when you measure? Well, when you measure, you have an accrual. What is accrual accounting? Essentially taking investment out of cash flows, if you will, and measuring it. But you're going to measure it with noise, right? Now, measuring would be good in this type of model because you essentially, I will show you, by measuring, you essentially prices would reflect forward-looking information. And that would make decisions efficient, economically efficient. Okay, so let's go to that kind of model and see. So it's very similar, they're very, very similar assumption. So this model is actually going to be a 2-date model, and 1 and 2, so it's a very simple model. Date 1, there is an investment. This pen is not very good. Date 1, there's an investment undertaken. And this investment is undertaken at date 1, and it's going to return cash flows of X1 or operating profit of X1, and at date 2, it's going to return operating profits of X2. Right? So I'm simplifying this here. You're taking a decision, an investment decision. The return is occurring shortly thereafter. I'm going to call that X1. And then there are also future cash flows where the return is going to be X2. So in fact, I'll call X1 and X2 the operating profits of the firm. And these are going to be measured. Think of these as fundamentals. The covariance between X1 and X2 is going to be positive, just like we saw in the case of Stein's model. Because again, we're in a similar model where learning something at date 1, you're going to be able to form beliefs about date 2. And the higher X1 will be, your belief would be that X2 will be higher. I'll put some statistical structure to this problem. X1 tilde is distributed normally with mean mu, and variance 1 over alpha. Then I'm going to call alpha the precision of X1 tilde. Right? Precision is the inverse of variance, right? So I'm going to call alpha the precision. You'll see why I'm going to work with precision in this model, because I'm going to use updating. So it'll be very useful to work with precision. So X1 tilde is distributed normally. The mean of X1 is mu. The precision is alpha. And X2 is going to be G of X1 tilde plus W. So I'm going to put some structure also in X2 now. It's G times X1. So think of G as a growth factor. And then W is just independent, orthogonal to X1. Right? This assumption is going to capture this structure in X2 implies that the covariance of X1 and X2, covariance on X1 tilde and X2 tilde is going to be G over alpha, right? Because it's the variance of X1, and the variance of X1 is 1 over alpha, which means that, by the way, X1 tilde is orthogonal to W. Right, they're independent. So that's just putting some structure on these operating returns or profits of the firm. Right? X1, X2 is G of X1 plus W. And the covariance between X1 and X2 is G over alpha. Of course, the mean of X1 is mu. That's obvious. And the mean of X2 is G mu, which implies that the mean of W is 0. Right? So W has a mean of 0 here. I don't think I need to specify the distribution of W. All I need is the distribution of X1, which is normally distributed. Okay. All right. So I'm going to call mu the scale of investment. And that's the choice made at date 1. Right? So mu is chosen at date 1. You're choosing the scale of investment at date 1, which is mu. So in a way, you're choosing the mean of these operating profits. Right? So that's the endogenous choice here in this model. So think of this as you're choosing the scale. I'll call that the scale of investment. And C of mu is the cost of, the expected cost of investment. And C of mu plus gamma is the actual cost of investment. So let me explain this. So you're choosing mu at date 1, which is the scale of investment, which affects the mean of the returns, X1 and X2, as we saw. C of mu is the expected cost of investment. So when you're choosing mu, you know the expected cost of this investment. C of mu. C is the cost function. But the actual cost of investment is C of mu plus gamma. So in other words, you could have a cost overrun or underrun, and that's captured by gamma. Right, the actual cost. The reason that the actual cost here is different from the expected cost, you'll see. Otherwise, in this kind of model, the market can make trivial inferences. The model is not very interesting. You'll see that in a second. Right? So CL mu plus gamma is the actual cost of investment, which means that gamma has, the mean of gamma is 0. And I'll tell you about the precision of gamma later on if we need it. Okay, so choose investment. Choosing mu at date 1 results in operating profits of x1 and x2. And here are essentially the statistical structure of these parameters, right? So CL mu is the cost of investment. It's going to be convex and so on. We can, C prime mu is positive. C prime prime of mu is also positive. So you have, it's a convex cost of investment. Mu is the scale of investment, right? There's no measurement issues yet. There's no accounting, but I'll bring it on now, right? So it's a very simple model so far. Choose investment, give you return. Okay, so what is observed by the market? What are the accounting ingredients here? The first thing is I'm going to call Z1, or Z1 if you prefer it, called that way, is x1 tilde minus CL mu plus gamma. I'm going to call that the net cash flows at date 1. I call that the net cash flows because at date 1, x1 is the return from your investment, but minus the actual cost of investment. Therefore, the net cash flows at date 1 is Z1. You can think of this as your statement of cash flows, if you will. I'm going to push this towards accounting. This is your cash flow from operations, you're returning, minus your cash flows from investment. Let's think of Z1 that way. And Z1 is the net cash flows at date 1, right? So X1 minus CL mu plus gamma. Remember, this is the actual cost of investment. So that's the net cash flows at date 1. Okay? Now, what does an accountant do in this economy? An accountant is going to try to measure the investment. Right? Make an accrual, if you will, and measure the investment. So you want to measure the investment. I'm going to call that essentially Z1 is, in this model, Z1 is observable to outsiders. However, Z1 confounds investment expenditures and operating profits or operating cash flows, right? Because they're commingled. It's X1 minus CL mu plus gamma. So even though Z1 is observable, you don't know each component, X1 from CL mu plus gamma. What you see is net cash flows. Right? That's what's going to be, that's always observable to outsiders. Right? That's observable to outsiders. So here is a primitive accounting system I'm going to introduce now. There's an accounting system. So accounting system will try to measure the firm's investment. By trying to separate operating profits from investment expenditures. That's what accountants do, right? You try to essentially measure what is an investment from what essentially is going to affect the current period, right? So go back to the fundamentals of accounting. If something's going to affect the future cash flows, you call that an asset, actually. You'll try to measure it, or at least you'll try to separate it. Anything that affects current period revenues, you'll leave it as an expense. That's the flavor here, right? Anything that is an investment, in fact, we'll put it on the balance sheet. R&D is not on the balance sheet, it's still expensed. But you at least try to measure it and separate it from other type of expenses, right? So that's what accounting systems here will try to do. Let's try to measure the investment, separate it from operating cash flows or operating profits. So I'm going to call that big K. Big K is the measured investment. And that's going to be, take the form C of mu plus gamma plus epsilon. So in trying to measure the investment expenditures, the accounting system will make mistakes. And that mistake is captured by epsilon here, right? So again, what I have in mind is whenever you're trying to separate operating expenses from investment, you make mistakes, right? Genuine mistakes, right? There's no misbehavior here because you don't know. I mean, imagine marketing or advertising, right? Go back to basics. Every dollar you spend on marketing, you don't know how much of that is going to affect your future cash flows. If you could, you would essentially measure that, report that separately as an asset perhaps, even on your balance sheet. But some of your marketing expenditure just affect the current period. That's part of your operating activities. Otherwise, what affect your future cash flows will be called your investing activities. And that's what accounting is doing throughout, right? Or striving to do. We are separating investment from operating activities. And of course, we know that even if you are genuinely doing it correctly, you're well-intentioned, you're making mistakes. And that mistake here is captured by epsilon. Of course, on top of that, you could argue that there might be misbehavior by insiders of the firm. They're deliberately inflating their investment. Think WorldCom, right? They're capitalizing all their line cost and putting it as an asset. But that's what the epsilon here. So epsilon here is the measurement noise in the accruals. Right? It's a measurement noise. It's not cash flows here. This is a measurement noise. Right? You're measuring things, you're making mistakes, and I capture that. Of course, what if you don't make mistakes? Well, then you'll get essentially investment won't be distorted. What we'll study is how does the precision of epsilon affect your investment choice? That's one of the objectives here in this simple model, right? So epsilon is measurement choice. In the accrual, we'll assume it's independent. It is independent of gamma for simplicity, right? Because that's not our objective here. You can make it dependent, but that's not going to give you more additional insight. More importantly, epsilon is distributed normally with mean 0 and precision beta. So beta is going to be used as a comparative static when we eventually derive mu. We're going to see how changing beta changes mu, essentially, your scale of investment. Right? So once you've measured, essentially, investment, now you made this accrual, now you can calculate the earnings of the firm. I'm going to call that Y. So Y is the firm's earnings or income. And we know that's going to be cash flows of Z1 or Z1. I'm going to add the accrual, the investment. Right? So essentially, I'm trying to remove investment from net cash flows by adding it back, but I'm adding back big K to Z1. What do I get? I get essentially X1 tilde minus C of mu plus gamma plus C of mu plus gamma plus epsilon, which means that I get X1 tilde plus epsilon. That's my earnings. So I'm doing accounting right now. I'll make a journal entry soon. Very soon. Right? That's what accrual is. You're essentially measuring investment and removing it from cash flows. Problem is you're making mistakes. Right? That's captured by epsilon. So if I overstate my investment if epsilon is very large and positive, I overstate my earnings. We know also that's a property of accounting, right? If you overstate assets, you overstate earnings, right? Which is the balance sheet, right? If you overstate assets, you overstate earnings, and that's the danger of essentially accrual accounting. The benefit, of course, we'll see in a minute is by separating by making an accrual, you're going to actually give incentives for the firm to invest, right? By measuring investment. Problem is if epsilon is very high, then of course your accrual is very noisy. That's not going to essentially help you much, right? But that's essentially what the role of accrual accounting is, right? It's measuring investment and removing it from cash. So a primitive economy, there's no accounting, there's no accrual accounting, you use cash, right? You solely rely on cash flows. But we know that the problem with cash flows is it's commingle operating and investment in expenditures. So the point of this model would be, what is the role of accruals? And what is the role of accrual would be essentially to give insiders the proper incentives to choose mu. So that's the real effect here. How does accrual, how does the precision of epsilon, how does beta affect mu? Essentially, that's where we're going. Right? That's where we're going. Questions? Yeah.
So in terms of interpretation, can that be as like a balance sheet item?
Say that again?
In terms of interpretation of the K investment,
Yeah.
is that like a balance?
Yeah, you can think of this as the balance sheet. So you can think of big K is what you're measuring and disclosing on your balance sheet. And the Y is your income statement. And of course, your Z1 is your statement of cash flows. Right? But here, of course, you could argue that this also could be on the income statement as long as you measure it and report it as a separate line item. Right? Because there's no distinction in my primitive model here between capitalizing versus expensing. All I'm saying is you measure it. But you can think of it as measuring it and putting it on the balance sheet. Right? That's one interpretation of this. And this is your income statement. Right? Because this is trying to measure operating profits. So you're taking Z1, adding back the investment. What's left is operating profits or returns. But of course, to the extent you make noise in your measurement, in your accruals, that noise is inherited by the income statement. Here's the epsilon.
So that one in cash flow, all of the public reserves is the net cash flow. They don't see a breakdown.
They don't see a breakdown, right? If they could see a breakdown, then they're, of course, in a way, they're seeing investment. So it's as if you think of the statement of cash flows, another way of thinking of the model is you see CFO, cash flow from operations, separately from CFI, right? That's one way of thinking about this model. You're able to break it. All I'm saying then is if you're able to separate the two, you make mistakes. And the mistakes is epsilon. It's a very simple model. But again, it's understanding, should you separate investment expenditures from operating expenses, what are the consequences? Right? What are the consequences? What are the real effects of doing this? Okay, so I've used two boards here, right? Yeah. Let me come here. I'll use this guy now. So firm's accounting system reports what at date 1, Z1, or Z1, Y1, or Y, I called it Y, well, here it's Y1, and big K at date 1. That's the information, right? So you have information from the statement of cash flows, if you use that language, from the balance sheet, and from the income statement. That's what the market is observing. Now, what we want to do now is essentially use this information to figure out what can the market learn about essentially mu, and how do you price the firm, right? So what information is contained? What information is contained in the accounting reports? Right? What information is contained in the accounting reports? Now, note one thing. Let's look at big K. So big K is C of mu plus gamma plus epsilon. What information can the market learn from this? Well, you see big K. It's basically C of mu plus gamma plus epsilon. But in a way, the market is not really learning much from this because mu is an action. It's a choice. Right? And then there is noise. So every time you see movements in K, remember mu is not a random variable. It's an endogenous choice again, just like we saw earlier. So you cannot form a distribution on big K. Right? Because mu doesn't have a distribution. It's an endogenous choice. But that doesn't mean, of course, measuring K is not going to have any implication, right? So big K is given by this, cannot be used by the market. to form posterior beliefs, to form any Bayesian inference, because it's an action observed with noise, right? It's not a random variable that you can use to update on mu. So it cannot form any Bayesian inference about firms' true investment. Right? Mu, the scale of investment here. Because mu is not a random variable. So given that mu is not a random variable, again, the market is rational. We're back to what we did earlier. The market will try to form a conjecture. So let mu hat be the market's conjecture about mu. Of course, we have to again verify later on that indeed the market can make that conjecture by understanding essentially the manager's incentives and so on. So let's mu hat be the market's conjecture about mu. Now, given mu hat, the capital market perceives Z1 to be equal to X1 minus C mu hat minus gamma. Do you agree? Because given your conjecture to be mu hat, the market views Z1 to be essentially a random variable of X1 tilde minus C mu hat, which now they know it's a point conjecture, minus gamma. Now this random variable now, Z1, has information content because it's giving you information about X1, which essentially might be used to form beliefs about X2. But this is given the market's conjecture, right? So the reason this is important is if you're seeing this for the first time, without the market's conjecture, we don't know the distribution of Z1. But once you make a conjecture, now you understand how Z1 is going to behave. It's X1 minus C mu hat, which is like a number, if you will. C mu hat is a number because a conjecture minus gamma, right? So that Z1 minus C mu hat is perceived as representing X1 tilde minus gamma. That's the information content, if you will, given the conjecture of Z1. Because you can once you conjecture mu to be mu hat, you can think of this signal as Z1 plus C mu hat equals X1 minus gamma. Right? So that's essentially what the market is going to be learning. Remember, the market doesn't observe X1. They observe Z1, Y, and K. But given their conjecture, Z1 is providing information about X1. With noise, though. The noise is the gamma. And that's why I needed the gamma earlier on when I told you guys that let's put some cost overrun, some shock to investment, because if gamma were not there, then of course observing Z1, once you make the conjecture, the market will perfectly learn at least that what X1 is, right? So now there is noisy information about X1, X1 minus gamma. That's what you learn from Z1. So first period, reported cash flows is informative about first period operating profit, which is X1. Because the covariance, so this is going to be key again, covariance between Z1 and X1 is really now the variance of X1, which is, we've assumed to be 1 over alpha, which is greater than 0. Right, so given the market's conjecture, the higher Z1 is, the market would believe that X1 is going to be high. Right? That's what is captured here. So given the market's conjecture, then the market says Z1 plus C mu hat is X1 minus gamma. The covariance between Z1 and X1 is the variance of X1, which is positive. Of course, it's 1 over gamma. So higher net cash flows at date 1 would imply higher operating profits. Right? Very similar to this model of Stein that I showed you guys earlier. Given the conjecture now, high Z1 is interpreted to be good news. Right? That's essentially what this is saying here. So that's about Z1. However, Let me push this up. Use this guy. Note that imprecise measurement of investment is not completely ignored. By that I mean that, remember I told you guys earlier that big K is CR mu plus gamma plus epsilon. That measurement of investment is not ignored because the measurement investment feeds into the income report. Y1 is equal to Z1 plus K that we saw earlier, which is equal to X1 plus epsilon. Right? So that the noisier the investment, noisier the measured investment is, the noisier income is, which is Y1. Right? By that I'm saying that the more mistakes you make in measuring investment big K, that's going to be inherited by the income statement, the Y1, right? Epsilon is going to be high. Right? But now, which means that both Z1 and, well, I call this Y1 now, I called it Y earlier. It's the same thing. Let's call it Y. So both Z1 and Y are informative about future cash flows X2. Right? Because Z1, it tells you, gives you information about X1 minus omega, gamma, while Y gives you information about X1, but it's also noisy. So there are two sources of information here. So that's the point of going back to what I was talking about earlier. There are two signals here, Z1 and Y. One is, think of in the nature of net cash flows. The other one is your income statement. So the market will use both to price the firm. What we want to study now is what are the implications of using net cash flows and the income statement. Well, they both are value relevant. But I will show you that the channel of disclosure is going to matter now. Whether the information is coming from cash or from the income statement is going to matter in terms of your choice of mu. Right? In terms of your choice of mu. Even though both are informative about X2, but the source of information will matter. I'll show you here that actually the accruals helps. The more weight you put on Y is going to be good for investment. It's going to enhance investment. Get it closer to economic efficiency. Problem is the more weight you put on Z1 is going to detract from economic efficiency. Because Z1 is backward looking. It's confounding operating profits and investment expenditures. Which means that the noisier your accruals, you're in bad shape. You rely more on cash flows. As you rely more on cash flows, that's going to reduce economic efficiency. Right, so let's see that in terms of the math and understand what's going on here. So here's the firm's objective function. It's going to be simple here. You're going to maximize expectation of P1. You're choosing, of course, mu, where P1 is the price of the firm at date 1. That's it. That's the objective function of the firm. Yeah.
So is the K also useful because in the cash flow statement, the noise is gamma, right?
Yes.
If I have a conjecture of investment, then K seems to be informed gamma.
No, once you make the conjecture that mu is going to be mu hat, your big K is just CR mu hat plus gamma plus epsilon. Right? But then what is the distribution of big K?
But I care about the distribution of gamma, right?
Yeah. You do care about the distribution of gamma, but you're not going to learn anything here from big K about gamma, because big K is just C mu hat plus gamma plus epsilon. So how are you going to form beliefs about big K? There's no distribution. Right? There's no distribution. So let's see. I'll show you. You can come back again and see how the market is going to learn about gamma. Yeah?
Stuck on that too, because K is a random variable. Because the variance is random.
That's true. Yeah, that's true. That's true. Yeah, that's true. But there's not going to be any additional information here to big K once you know Z1 and X1. Do you agree? Because you can recover one from the other. Once you know two, you can get the third one. Right? So you have, in other words, Z1, what is Z1? Z1 is Y minus K. So if I have Z1 and K, I know, right? I know Y. So I only need two pieces of information out of the three. Okay? So let's see. Let's see what would happen here. So what is P1, the price of the firm at date 1? P1 is essentially Z1, which is the cash flows that have been realized, plus expectation of X2 given, now I'm going to call this the market Phi1, given Phi1, where Phi1 is the market's information. At date 1. Right? And we know that Phi1 in our world is Z1, Y, big K. Right? So I'm allowing big K to play an informational role here. Right? We're going to use all the information we have. It's not that we're ignoring big K. But of course, once we know Z1, Y, and big K, I only need two of these pieces of information. The third one is always redundant because I can always recover it. Right? I can always recover big K from Z1 and Y, or I can recover Z from Y and K, and so on. So I need two pieces of information. Okay, so that's the price. Now note the price, the way I've written the price here. The price is just, at date 1, is you're pricing the net cash flows, which is Z1, plus beliefs about future cash flows given the market's information, right? And the market's information here is Phi1, which is Z1, Y, comma K, right? And the firm is maximizing that. Again, I'm back to essentially, the generic model, which is you care about prices. You don't care about terminal cash flows. If you care about terminal cash flows, you will not be maximizing this. You will be maximizing E of Z1 plus E of X2, right? But here I care about prices. And prices depends on information the market has. Information the market has depends on accounting measurement and disclosure. What's disclosed by the accounting system? And what's disclosed by the accounting system in this model is Z1, Y, comma K. Okay, now before I get into the prices, what is the benchmark here? It's pretty obvious. Suppose you cared about terminal cash flows, just quickly do this as a benchmark. What would be the choice of mu? So what do I... benchmark. Use this. I'm too short. Maximize expected cash flows from investment, which is max by choice of mu, expectation of Z1 plus expectation of X2, right? Yeah, given mu if you want. We can put mu here because you're choosing mu. So you know mu here, this is the insiders, and the insiders are just choosing an investment, scale of investment mu, to maximize the expected net return, right? So that's like the Robinson Crusoe world. You invest, you care about just the cash you'll generate in the future, and you'll consume that. You don't care about prices, you don't care about the way you're perceived in the market, and so on. Now what is this? This is the same as maximizing. Now I'm going to write expectation of Z1 given mu So if you take the expectation of a Z1, choice of mu, you'll get mu, because that's expectation of X1, minus expectation of C of mu plus gamma, which is just C of mu. Expectation of gamma is 0. So that's expectation of Z1 given mu, plus expectation of X2 given mu. That's G times expectation of X1, plus expectation of W, which is 0. So this is G mu, right, in terms of the left boards there. So that's essentially what the expectation of X2 is. First order condition, choice of mu, you'll get 1 plus G is equal to C prime of mu. Right, so that's the benchmark, right? You choose investment, you choose mu such that the marginal cost of investment is equal to the marginal expected short-term return, which is 1. That's the impact of choosing mu on E of Z, or Z1. And the marginal return from mu on long-term return, which is G. Right? So that's, if you will, is a benchmark. Yeah, that's the decision rule to choose mu. Set marginal cost of investment equal to marginal short-term plus marginal long-term return. Right? Now, what happens when P1 is of this form? Of course, we know the objective function is now P1. Again, we know that if mu were public, well, we'll get back essentially the first best decision. We can quickly verify that. If mu is known by the capital market, then we can calculate essentially phi1 then, and there is no noise in investment, then of course P1 would be Z1 plus E of X2 in a way given X1, right? Because if there's no noise in investment and there is no information asymmetry at all or anything else, then we know that P1 is equal to Z1 plus E of X2 given X1, right? I've replaced Z1, Y, and K by X1 directly, and we know this is Z1 plus, and then E of P1 given mu, this is ex ante, would be mu minus C of mu plus E of X2, which is G times mu. Right, so we're back to essentially the same decision rule. If there's no measurement noise in the market, you essentially will get the same decision rule, even though you're maximizing price. Right? This is back again to the benchmark. There's no information problems. X1 can be credibly disclosed to the market. Well, then you'll choose the first best level of mu, right? Setting marginal cost equal to marginal short-term and long-term return. But we're not in this world. We're in a world in which you observe phi1 is equal to Z1, Y, comma, given K. What information can the market extract about X1 from this? That's what we want now. If X1 was known, we're back to first best. So what can we learn about the statement from the statement of cash flows, from the income statement, and from the measured choice of investment about X1? And how does that in turn affect the choice of mu? Right? How does that affect the choice of mu? So how do we do this? Now I need to raise, can I raise this top board here? So, in other words, what is E of X2 given Z1 Y cap K? How is the market going to calculate this? It doesn't know mu. Can only form a conjecture about mu. Yeah, how are you?
The decision choice is mu.
Yeah.
The firm knows what mu is.
Yes,
Sure.
for sure.
Why can't it credit pay?
Oh, of course. No. That's, remember, because there's an assumption here that mu cannot be credibly disclosed to the market.
Okay, otherwise Stephen can vote for it.
Huh?
Well, otherwise we just go to process.
Yeah, we go to first best, right? We go to first best. Now, the key friction here is mu cannot be credibly. What is mu? Mu is essentially the mean level of investment. And that cannot be disclosed to the market. If you could disclose that to the market, problem goes away, right? Because the investment, then you can observe the investment perfectly.
But mu is a hard number.
Yeah. Oh, well, I mean, you think of essentially mu being an intangible investment of the firm. That's what I have in mind. It's not property, plant, and equipment, to put it in the language of an accountant. Mu is like investment in brands, right? Or mu is investment in essentially, the building customer relationship and so on. So it cannot be credibly disclosed. No, so that's the assumption here. Mu is in the nature of an investment, an intangible investment that cannot be credibly disclosed to the market. The only way you can disclose to the market is via the returns from the investment, which is the statement of cash flows or the income statement, right? Or the income statement. If you could disclose mu credibly, then problem goes away. Surely. You cannot. But thanks for bringing that up, of course. That's an important point. Cannot be disclosed. So what is E of x2 given z1, y given k? Now, how would we evaluate this? Now, remember, z1 is viewed by the market to be x1 minus c of mu hat minus gamma. While y is x1 tilde plus epsilon. And we know what these are. This is just the cost overrun. Epsilon is measurement noise in their accruals. Right? Of course, there's also k here if you want to write this, but we know that k is c of mu hat plus gamma tilde plus epsilon. So how can the market use this information to form beliefs about x2? Well, there are two signals here, if you will, about x1, right? Which is z1 and y. Right? Given the market's conjecture, there are two signals about x1, which is z1 and y, and we know that x1 is correlated with x2. So how would we calculate this conditional expectation? Well, given the assumptions we've made, I'm going to write it as follows. This can be written as, again, I'm just going to use z1 and y, because that's exploiting all the information we can. I'm going to rewrite this as this is g of e of x1 tilde given z1 comma y, which is g of, now I'll write it and then we'll discuss what I'm doing here. Where delta is the precision of gamma, and alpha, we've already talked about this, is the prior precision of x1 tilde, and beta is the precision of epsilon. This is the market's conditional expectation of x1. So first of all, from here to here, I've just exploited the fact that x2 is g of x1 plus w, right? That's the structure. So expectation of x2 given z1 comma y is expectation g times expectation of x1 given z1 comma y plus expectation of w, which is 0. So that's gone. So I get this. So the g is a factor. Now what is this conditional expectation? Now I'm going to exploit normality. Z1 is normally distributed given the market's conjecture, right? Because Z1 is of the form x1 minus c of mu hat minus gamma. Now given the market's conjecture, Z1 is x1 minus c of mu hat minus gamma. X1 is normally distributed, gamma is normally distributed, which means Z1 is normally distributed. But I've written it as, another way of writing this signal is Z1 plus C of mu hat is x1 tilde minus gamma. Right? So that's the signal essentially the market is observing about x1. It's Z1 plus C of mu hat. That's what you're observing. it's x1 tilde minus gamma. And then the third signal is, of course, y. Y is x1 tilde plus epsilon. Now, what I've written here is the posterior, directly. And what I've exploited here is the following fact. If you have signals that, so z1 and y here, that are of the form of x1 plus noise, you can directly write the conditional expectation using the precision of the weights. That's it's weighted precision. So for example, the weight I'll put on the prior mean of, what is the mean of x1? It's essentially mu hat, because that's the Marquette's conjecture. The weight on that would be the precision of x1 over the sum of the precisions of all the signals the Marquette is observing, which is essentially the prior plus the precision of y plus the precision of z1. What weight should I put on z1? Well, it's really z1 plus c of mu hat, because I want to write it in the form of x1 plus or minus noise. It's the precision of z1 over the sum of the precision of all the other signals. And finally, what weight should I put on the earnings income statement? It's the precision of epsilon, which is beta, over the sum of the precision of the other signals, right? Again, this is a well-known result I'm exploiting in statistics, right? It goes as follows. Again, that's another part of your toolkit. If you have, more generally, suppose y is equal to, so y I is equal to xi plus some noise epsilon I. But I is from 1 to n. So you have n signals. Right? Sorry, no, this is x. So you have n signals about x. And they all take the form x plus some white noise. What? Epsilon I is distributed normally with mean 0 and say let precision alpha I. What is the expectation of x given all these signals? y1 dot 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 yn. I can just write it as follows. And let's say that x itself is normally distributed with precision of, okay, let me change this slightly so we don't get confused. X has mean mu and precision alpha. Then expectation of x given all these signals you're observing is alpha mu plus beta 1 y1 plus beta 2 y2 plus dot 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 beta n yn over alpha plus beta 1 plus beta 2. So I'm exploiting this result here. Right? Again, another well-known result in statistics. It's very intuitive. You have n signals about x. You care about x. What is the posterior of x given all these signals? Well, the weight you put on the prior is the weight of essentially the prior precision of x, which is alpha, times the prior, the prior mean, and then you scale it by the sum of the precision of all the signals, right, including the prior. And then the weight you put on y1 is, so it's relative precision. Right? It's precision weighted. That's what I'm exploiting here. Here, to put this in the same, to relate this result here, z1 is x1 plus c of mu hat minus gamma. I send the c of mu hat to the left-hand side. I have a signal on, now I have a signal on x1, but that signal is z1 plus c of mu hat. It's x1 tilde minus gamma. The other signal is y is equal to x1 plus epsilon. I want to form beliefs about x1. Given z1, y, and the conjecture, I can write it as follows. Here's the prior. Here is the weight I put on z1 plus c of mu hat, which is the second signal. And here's the weight I put on y. Right? The same thing. Okay, so that's another thing, part of your toolkit. You just invoke these results, right? Because this is normality. So that's what I'm using here. So that's E of x2 given z1 comma 1. Right? Now, of course, what is P then? P is, or P1 is z1 plus g of alpha mu hat plus delta times z1 plus c of mu hat plus beta y over alpha plus beta plus delta. Right? That's the pricing rule. Now, at date 0, at date 1, the manager is choosing mu, and forming expectation of P1. Of course, P1 is a random variable because right before choosing investment, Z1 has not been realized, neither has Y. Right? So I'm going to form expectation of P1. I'm really forming expectation of all these. What do I get? I get expectation of Z1 plus delta G over alpha plus beta plus delta, expectation of Z1. I'm going to ignore terms that do not depend on mu, plus beta G over alpha plus beta plus delta, expectation of Y. Right? And I've ignored the alpha mu hat and the delta C of mu hat because they're constants. Right? So expectation of Z1 plus delta G, expectation of Z1 plus beta G, expectation of Y. So that's from the date 0 date 1, I'm sorry, insider's perspective when you're choosing mu. Okay? Yeah.
Just going back to what we were talking about before, so I understand how Y and how Z1 plus C of mu hat, or say X1, but your mu hat, how does that relate to these other two signals again? So those.
Here is mu hat embedded in Z1, right? Because once you form a conjecture, you say, essentially, I'm going to conjecture what mu hat is. The market views Z1 to be X1 minus their conjecture, minus gamma. So really now they're saying that given mu hat, we have information about X1 because Z1 plus C of mu hat is X1 minus gamma. So they're learning something about X1, given their conjecture. Same thing with Y, but Y doesn't contain the conjecture, right? Y is X1 plus epsilon. Of course, when the market is going to calculate the mean of Y, which we'll see in a minute, here, the mean of Y from the market perspective is going to be, well, the market is not going to calculate mean of Y. The insider is going to calculate the mean of Y. That will become, mu will pop out here, right? Because this is the true choice of mu. Same thing here, E of Z1, the true choice of mu will pop out. But the conjectures are embedded in the pricing rule, right? Because the market, here it is, and here it is again. Did I answer your question?
Yeah, more or less, I was looking at the alpha mu hat and how that corresponds. You said that was the posterior?
Remember, this is the market calculating the posterior of X1, given all the information that they have and their conjecture. What weight are they going to put on the prior mean of X1? It's alpha over alpha plus beta plus delta, right? Because they have, in a way, three signals here. Their prior plus augmented by the income statement or the income report, beta, and then the cash flow report. So the weight they'll put on their prior is, it's a weight. It's alpha over alpha plus beta over delta times the prior mean. The weight they'll put on the cash flow is Z1 plus C of mu hat, and the precision of Z1 is delta. And the weight they'll put on the income report is beta over alpha plus beta plus delta. Right? So that's essentially the market's calculation of the posterior, which I've substituted here in the pricing rule. At date 1 now, the insider takes the pricing rule as given and optimizes. And when you're optimizing, you know that your choice of mu is going to affect the distribution of Z1, which is here and here, and also the distribution of Y. Right? That's any other clarification or questions? Anything that's bugging you? This is a good time. Okay. So now, what is this? What is this? The markets. What is the insiders? What is the choice going to be of mu? So I'm going to erase this here. Use this side. Right. So this implies that maximizing a choice of mu E of P1 is the same as maximizing. Now I'm going to calculate these expectations. Mu minus C of mu plus, now I'm going to change this. I'm going to call this here beta z times mu minus CO mu plus beta y times mu, where beta z, by definition, is delta g over alpha plus beta plus delta, and beta y is beta g over alpha plus beta plus delta. Right? So that's the ex ante objective function of the manager, which boils down to this. Now, where did I get this? I calculated the expectation of Z1, which is mu. Remember, Z1 is x1 minus CO mu minus gamma. Taking the expectation over that, I'll get expectation of x1, which is mu, minus CO mu, expectation of gamma is 0. So that's the term. Plus, I'm going to call this term beta z. That's the coefficient on x1. Beta z times, again, mu minus CO mu. Plus, I'm going to call this coefficient here beta sub y. Beta sub y times expectation of y, which is expectation of x1 plus expectation of epsilon. Expectation of x1 is mu. So that's where I got this term. Right? Which means that the first order condition for choice of mu, do I have a board? Yes. So the first order condition can be written as follows. So C prime of mu equals what? Sorry? C prime of mu, so I'm factoring, so I'm taking the first order condition here. So 1 minus C prime of mu, and then I factor out, so 1 plus beta z plus beta y. So it's going to be 1 plus, okay, let's do it slowly. I can't do it in my head. 1 minus C prime of mu, that's from the first term, plus beta z times 1 minus C prime of mu, that's from the second term, plus beta y is equal to 0. Right? Then that means that C prime of mu times 1 plus beta z equals 1 plus b sub y over 1 plus b sub y. That's it, right? Plus b sub z. Yeah, from this term. Which implies that C prime of mu is equal to 1 plus b sub y over 1 plus b sub z. I think that's correct. We'll see in a minute if it's not. Right, because our comparative statics won't work. Okay, so C prime mu is equal to 1 plus b sub y over 1 plus b sub z, where b sub y and b sub z have meaning. I've just essentially, right? In a way, b sub y is the weight that you put on the, right, is the coefficient on the income report. B sub z is the coefficient on the cash flow report, right? So that's the form. Now, how does that compare with economic efficiency, which is the benchmark on the right-hand side, right? What is the benchmark on the right-hand side? In other words, to figure out the distortion, right, we need to figure out how does b sub y over 1 plus b sub z compare with what? G, exactly. So that's first thing. Is it lower than G? Is it higher than G? When does it approach G? And so on. And more importantly for us, how does the weight that you put on B sub Z, as the weight you put on the statement of cash flow report increase, what does it do to your investment efficiency? right? Or as the weight you put on the income report increase, what does that do to economic impact? So first of all, B sub y over 1 plus B sub z is what? Well, we can calculate it from here, right? B sub y over 1 plus B sub z is, okay, let me cheat here. I've done this in my notes. But first of all, by the way, the market's conjecture is verified. Do you agree? Because here's the first order condition for choice of mu. The market can essentially, B sub y over B and B sub z are all common knowledge. They're all parameters. So the market can essentially calculate the firm's choice of mu, which means that the conjecture we made at the beginning to be mu hat was not in vain. It's verified in equilibrium because this decision rule essentially can be anticipated by the market because they're rational, right? So the market's conjecture is verified, right? There's nothing that the market doesn't know about this decision rule, right? That's the way you verify these conjectures in these rational expectations model. You make a conjecture, you price the firm, then the firm optimizes, then in equilibrium, does the decision, the actual choice of mu chosen by the firm, can that be anticipated by the market? The answer is yes here, right? We verified it. So that's the first thing. Second thing is B sub y over 1 plus B sub z. If we were to calculate this, verify this, you'll get beta g over alpha plus beta plus delta times 1 plus g. Right? Just by taking the ratio. Beta y over 1 plus beta z. Now, how does this compare with g? Strictly less than g. Right? It's strictly less than g because delta times 1 plus g is positive, alpha is positive. If these two terms were 0, then this would be equal to g because the beta will cancel. So this is strictly less than g, which means that there is underinvestment in mu. Right? There's underinvestment in mu by underinvestment compared to first best economic efficiency. More important, so there's underinvestment. So the first thing is underinvestment in mu. Right? In other words, mu star is strictly less than mu full information. Mu star is the mu that arises here that satisfies this condition. Call it that. Second, to understand why there's underinvestment, as this term here, as delta essentially, as beta increases, or let's say beta decreases, what happens to this fraction? In other words, as essentially you put less and less weight on as the precision of the earnings report goes down, what happens to this fraction? Beta goes to 0. This is actually increasing or decreasing in beta? This is increasing in beta. You can verify this. This is increasing in beta. So as beta is going down, so as beta decreases, beta y over 1 plus beta z decreases, which means that underinvestment becomes higher and higher, more severe. Right? Or conversely, as delta, right? Delta is the precision on you can see it right here, maybe more. As beta increases, what happens to B sub z? As beta increases, beta sub z goes down, right? Because it's only in the denominator. And beta sub y is going up. So as the precision of measuring investment goes up, you put less and less weight on the statement of cash flows and the cash flow report, and more weight on the income report. Right? Or conversely, suppose that beta is 0. There is no measurement of investment at all. What happens to beta y? 0. If beta is 0, the numerator is 0. Well, beta z is not 0 if beta goes to 0. Which means that if you don't measure accruals at all, beta y goes essentially to 0, which means that what happens to this term right here? This term becomes 0. Why is that? So why is it that the more weight you put on the cash flow report, underinvestment problems become more severe. But the more weight you put on the income report, the underinvestment is less severe. In fact, as beta tends to infinity, what happens to this term? Becomes G, right? As beta goes to infinity means that you basically y is reporting x1 in the limit. If you report x1, we know that you should get first best. We saw that earlier, right, on the right board, which means that as beta goes to infinity, this tends to G. As beta goes to 0, then of course you get severe underinvestment because C prime of mu star tends to 1. This term drops out. Why is that? What's going on here? What's the insight? Anyone? Why is it that putting any weight on this cash flow report is detrimental to investment? But putting weight on the income report enhances investment, gets you closer and closer to economic efficiency. In the limit, you get economic efficiency as Y basically discloses X1. Anyone? Yeah.
This investment hurts the short-term cash flow because short-term cash flow has deducted investment from the
Okay.
cash flow, right? But investment increases Y, which is income statement, which I have incentive same against the income statement. So the more we have the income statement, the more incentive I have to invest.
Yeah, but there's no single jamming here to the income statement. The intuition boils down, you're right, the intuition boils down to what we saw even in the Stein model. Look at Z1. Z1 is X1 minus C of mu minus gamma, while Y is X1 plus epsilon. Now, given the market's conjecture, so I'll put mu hat here, the market views Z1 to be higher the Z1 is, the higher the market believes X1 is. Therefore, the higher X2 is. Which means that, right, given the market's conjecture, covariance of Z1 and X1 is essentially 1 over alpha, which is positive. Given that the insiders say that we need to boost Z1 because that's going to convey that future cash flows will be very high. How do you boost Z1? By cutting back on mu. Cutting back on mu. Because from the firm's perspective, ex ante, to boost Z1, you need to cut back on investment. So you cut back on mu. By cutting back on mu, you're boosting Z1. Right? But that effect is not present for Y. Here, covariance of Y and X1 is also 1 over alpha. But here you can see that there is no cutting back on investment. Your choice of mu doesn't affect. In fact, your choice of mu is aligned with increasing Y. Because the higher mu is, the higher is the expected value of Y. But here the expected value of Z1 is mu minus C of mu. Right? In other words, when investment expenditures are commingled with your operating profits, there is unfortunately a dual role to investment. Investment increases Z1, but there's an informational cost to investment. Right? Because you know that the market is forming beliefs about future cash flows from Z1. And therefore, you want to cut back on mu to convey to the market that X1 is very high. Right? So therefore, Z1, using Z1 to basically price the firm has a detrimental effect. Right? Which is, the effect from X1 is, if you increase mu, it increases X1, increases Z1. That's the good side of it. Problem is there's this informational cost. Because ex ante, you know that if you choose a very high mu, it increases the expected value of X1, but it also reduces the expected value of Z1 because C of mu is higher. And the market is using values of Z1 to form beliefs about future cash flows. You hear this argument a lot by firms, right? We want to underinvestment in intangible investment because if we invest in R&D, it reduces our earnings. Right? They use it in the context of earnings. We invest in R&D, it reduces our earnings because we are being priced based on earnings. The market cannot really understand that this R&D investment is reducing our income because it's being expensed. Therefore, once we are being priced, basically market is using earnings as a signal to predict future cash flows, we acquire an incentive to cut back on R&D. By cutting back on R&D, we're boosting our short-term earnings and then conveying to the market our future cash flows is very high, right? You know, there's this survey by that is very popular now. What is it? But yeah, Harvey and yeah, they ask CEOs, CFOs, right? Would you cut back on R&D if the market is not understanding your business model? Would you cut back on R&D to boost your earnings? And most of them said, yes, we will. Right? I'm not saying that this model is directly, but it has that flavor, which is saying that when the market cannot disentangle your operating profits, right, from your investment decision, suddenly now your investment has an informational cost. Because if you invest, all that the market is seeing is your net cash flows, and they're pricing you based on that, you get an incentive to cut back on your investment expenditures, right, to boost that signal. Right? So the more weight you put on essentially Z1, that detracts from economic efficiency, right? So as beta goes up, as beta goes down, that means that you're putting more and more weight on Z1. As you put more weight on Z1, that means essentially that B sub Y over 1 plus B sub Z is dropping, which means that you are moving further and further away from investment efficiency. In the limit, if you don't measure accruals at all, then you're extremely myopic in your investment. You're setting marginal cost of investment equal to 1, because in the limit, B sub Y, if beta is 0, B sub Y is 0, this term drops out. So now you're essentially investing in a very myopic way. You're setting marginal cost of investment equal to marginal return. You can see it very well here, because essentially what's happening is this term is dropping out. So now all you care about is boosting this, right? Because this is a factor. This is like maximizing 1 plus B sub Z times mu minus C of mu. Now you care about maximizing this term. You're taking into account that you're internalizing this cost of investment. You're saying that the market is pricing mu minus C sub mu. Therefore, you'll set C prime mu equal to 1. But that's extremely myopic. Less weight you put, if you get rid of this guy, less weight you put on the cash flow report, now you see that the only cost of investment is the actual cost of investment. The return is, this is the short-term return, this is the long-term return. You're being aligned with economic efficiency. Right? So more weight you put on the earnings report, the more forward-looking you are, the more your incentives are aligned to maximize economic efficiency. But more weight you put on the cash flow statement, now you're investing in a very myopic way, because your incentive is to maximize mu minus C of mu, right? Which is essentially, investing in a very myopic way, because then you're setting the marginal cost of investment equal to the marginal short-term return, not the long-term return. Right? Now, this is a very stylized model. I'm not saying that this is exactly, but it at least captures the flavor of what are essentially the role of accruals for accounting. The good side of accruals is allows you to take a long view, right? You're measuring investment and removing it from cash flows. Earnings allows you to essentially take a forward view. And it's good for investment decision in the long run. The cash flows is not, because cash flows is commingling operating expenses with investment expenses, expenditures. And if you basically, the market is looking at the net of those two, it's confounding operating expenses with investment expenses, then essentially decisions can be distorted. By measuring it appropriately, you are essentially getting the manager to make the right decision. Of course, I've assumed here that the measurement is noisy, it's epsilon. In practice, you can imagine that this can be manipulated. And that's what we hear about, right? Once you have accruals, you give discretion, then you can manipulate accruals and so on, right? And therefore, a measure of accounting quality here would be, again, the weight that you put on. So this is a measure of accounting quality, by the way, in this setting, right? How does this compare to G, right? Because this is essentially telling you the weight that you're putting on the income, more weight you put on your income statement, and therefore the less weight you put on the statement of cash flows is good for economic efficiency. And how is that changing over time? Right? How does better accounting standards, or better accruals, if you will, better accruals will essentially means that the precision of epsilon is essentially very high, right? You're measuring X1 with a high precision. Yeah?
So I have two comments. The first one is, I actually view this, like you said, it's about accruals, accruals information. I view this management. I was thinking about some like empirical prediction on like if you have better accounting quality, that there will be like less real earnings management or something.
Yeah. You know, I have a problem with this term, real earnings management. but let me tell you why. I think this is what accountants call it, right? This is completely an accounting invention called earning. Everything a manager does is to manage earnings. So I don't know, right? Everything you do is manage earnings. But every project that you're choosing, you're managing earnings, changing earnings. So I believe what accountants mean by that is somehow you can separate accruals from decisions. But for me, I don't see that. I don't view that as very plausible in practice, because the project that you choose changes the nature of the accruals. So it's very difficult for me to separate that. I think I know what they mean. They say, oh, you are not doing accruals that do not affect decisions. You're just changing the decisions themselves. That's what they mean by real earnings management. So I'll leave it at that.
Also, like the second comment I have is in terms of the underinvesting the result.
Yeah.
Is that dependent on like the convexity of the C function?
No, the convexity of the C function is just to get you an interior solution here. It has nothing to do with that. The underinvestment is arising simply because, versus saying why is there no overinvestment here, right? For example. The reason is, so in any game where there are hidden action, no hidden information, typically you'll get underinvestment. This is a game, in economics we call this a game of hidden action. Action here being mu. In games of hidden action, you tend to get underinvestment. In games of hidden information, you tend to get overinvestment, which I'll talk about in the afternoon, a game of hidden information. Here, mu is essentially viewed as a hidden action. The reason you're getting underinvestment, of course, is coming directly from Z1 and also from Y, because essentially, if you are being priced based on cash flows, again, you have an incentive to cut back on investment. And that's where it's really coming from.
Because I was actually looking at the benchmark first one.
Yeah.
So G is always bigger than only if.
No, but, yeah, so the underinvestment here is coming because you can see these terms, right? It's coming from really this term, right? Without this term, and of course also alpha, these two terms is what's really causing the underinvestment. And this term is because you are putting weight on the cash flows. As you put weight on the cash flows, that detracts from economic efficiency for a reason we've talked about, right? Because mu has an informational cost. By cutting back mu, you boost Z1. So that's where this term is coming from. If delta goes to 0, you can see that this approaches G. Alpha is because there is imprecision. If beta were 1, you will never put any weight on the priors, because Y basically discloses X1. So those are the two reasons, right? The accrual is noisy, and there's an informational cost to investment. Those two effects taken together leads to underinvestment. Right? Even if did not put any weight on the cash flow report, you'll have underinvestment because of epsilon, right? Because Y is noisy. Unless beta is 1, right? Beta is infinity, then you'll get first best. That's why you see here that the only way you get first best is beta approaches infinity. This converges to G.
Maybe I still need to
Okay.
incorrectly.
Yeah.
I thought like when you say G is greater than that function, that implies mu is smaller than the first best. I thought this condition only holds when C is complex.
No. No.
But I think if C was concave, then it would result in an overinvestment model.
The first of the condition is C.
Let me think about that.
Create second order condition issues if you venture on this too much. You wouldn't get local.
Yeah, but I think we need to stick to an environment where you have an interior, right? To get an interior, you need a convex C function. Once you have that, then compared to that interior, first best, you always get underinvestment here. Right? And the key thing, the reason for underinvestment here is because, two reasons again. You're relying on Z1 and Y. Z1 is bad for, causes underinvestment because of the informational cost again. And Y causes even if there was no Z1, meaning that the weight on beta Z is 0, what will the decision be? 1 plus B sub Y. And B sub Y is always less than G because of the noise in the accruals. That's the reason you're getting underinvestment. Okay? Yes?
Yeah, so I know I asked a stupid question before.
No, I never said it's stupid.
The balance sheet,
Yes.
the balance sheet income statement and cash flow, one
Yes.
of them is redundant because
Yeah.
one,
Yes.
they add up to be the other.
Right.
But we observe that the firm discloses all of them, right?
Yeah.
So what is missing, what frictions or assumptions missing from the model that prevents all three variables being used for?
So what's missing is the following. There is no private information here. Right? I'll show you in the afternoon models where, imagine a world in which mu is not an action. It's privately known by the insider. Now observing big K is going to have essentially, right, informational value. In other words, I'm going to a world where K behaves like a signaling device. That's what's missing. So again, this is a game of hidden action. Once you've conjectured the action, K itself is not going to reveal any information because every time you see fluctuations in K, given your conjecture, you'll attribute it to movements in gamma and epsilon. And as long as there's no moving support, right? And there's no moving support here because gamma and epsilons are normally distributed, right? But there's a good point. If somehow there were no moving support, then K could also reveal information, right, about this. So those are the assumptions. Yeah?
Just add to that, in this case, K is fully reviewed by given Z1 and Y, right? Because K is
Yes, exactly.
just equal to Y
Yes,
minus that Y.
exactly.
You don't really need it.
That's right. Remember, you just need 2 out of the 3. You can recover the third one always. One is always redundant here. Yeah, but
Only this model.
yeah, in this context, yeah. Of course, there are other settings where you could end up using even the K. But we'll see that in the afternoon. Not here. Here, once you know 2, the third is redundant. Okay, so just to close this model again here, what did we learn? Besides doing posteriors, what we learned is the following. Settings in which there are disclosing information, going back to the discussion earlier in the morning, Z1 here and Y are both value relevant, meaning that they're priced. They're used to price the firm. We saw that. You put weights on them. However, disclosing via Z is not good for economic efficiency. Disclosing via Y is good for economic efficiency. So the channel of disclosure, the term I used this morning, matters. Why? It doesn't matter from in a pure exchange economy. In a pure exchange economy, all you care about is having more information. But in a real effects economy, it matters because in a real effects economy, disclosing via the cash flows detracts from economic efficiency because there's an informational cost. When you commingle operating profits with investment expenditures, and Z1 is being used to form forecasts about future cash flows, the manager has an incentive to boost Z1 by cutting back on investment. While the disclosing through Y doesn't have that problem, barring the noise. Barring also misbehavior by the insiders if they manipulate epsilon, which I've ignored here in this model. Right? I wanted to show you a model where I want to do comparative statics on beta and show you. Of course, it is possible if you write a different kind of model, perhaps Z1 could dominate Y in the sense that you are engaging in, you're manipulating epsilon. Right? Oh, epsilon has a lot of noise. Right? You don't want to measure it per se. But still here, epsilon will always be good in this kind of model because there's a huge informational cost if you use Z1 to price the firm, right? So the channel of disclosure matters. The channel of disclosure matters. That's what essentially is the message here. Yeah.
So, if I understand correctly, the lower you receive closer to first best.
Now let's see. What is gamma? So gamma is the noise in investment. That's the cost overrun or underrun in investment. So that's delta, right? The precision of gamma is delta. So let's investigate that. So say that again.
If you decrease delta, so you decrease the precision of the cost of investment, of the release cost, this ratio is going to increase. Right?
Well, let's see it right here. As delta increases, meaning that the precision of gamma is increasing, beta y goes down unambiguously, right? It's in the denominator. Beta z actually goes up. And you put more weight on this. The problem then is what happens to economic efficiency? It goes down, right? Why is that? In fact, let's take it to the limit. Delta is infinity, which means that z1 is x1 minus c of mu. Then you never put any weight on the income report.
Yes, so,
You get c prime of mu equals what? Equals 1.
yes, so that means that if you have an investment whose cost is really noisily observable, you're closer to first best.
No, you're not closer to first best. Because beta y is 0. You get c prime of mu equals 1.
No. Wait. If the precision is going down,
Oh, the precision of... Okay.
right? So you have more noise in the observation.
Okay. So you're saying the opposite. So then, yeah, you're right. So then beta z is tending to 0. Beta y is going up.
So the noisier the observation of the cost of your investment, the
Yeah.
closer to first.
Yeah, that's good actually. Yes.
So that means that let's compare R&D and PP&E.
Okay.
Right? You would argue that investment in R&D is going to be noisy to observe,
Yeah.
noisier than investment.
Yeah, you could argue that, yeah.
Close to first best, that's first best investment in R&D compared to PP&E. Am I doing something wrong?
No. I mean, you have to remember though, yeah, okay, so another way of asking your question is, in this setting here, the noisier the measurement of investment, the noisier, not the measurement of investment, the precision of the gamma as that goes down, right? That's good for investment efficiency.
I mean, I understand.
No, that's true. The reason, first of all, let's understand why this is going on. The reason is because the lower delta is, meaning the noisier the precision of gamma is, the more weight you'll put on the earned income report, right? Which is good for economic efficiency. Now you're saying that let's compare two types of investments and see how their precisions could be different from each other. Yeah.
Noisier cost and getting closer to first best.
Yeah, the reason this is operating here is simply because you put less weight, right, on you, because this is not a useful signal anymore to learn about X1. That's all that's going on here. Yeah. Anything else? Should I continue? What time? We still have time, right? So let me start. Yeah, let me start. We have to quit at what time for lunch? 12:45? 12:45. Okay. So let me now just trying to anticipate what I'm doing in the afternoon. Okay, let me now move on to, I was going to move on to a model of tangible and intangible investments, but that's going to take, I think I want to move on and switch gears a little bit to a model of models for private information, right? Information asymmetry. So these are models of hidden action. So let me describe it's a good workout here. Did John Glover yesterday use the board or use slides? Cheated. No, it's okay. I mean, I think you can cover much more with slides, obviously. So maybe I should continue on this theme of tangible, intangible investments with one more model. I think it's better I do that. So let me start one more model. We'll finish it. We'll go to hidden information asymmetry later. So the insight from this model we just saw on the board is if you can measure investment very precisely, do so. Disclose it as precisely as possible. In the limit, you'll actually get economic efficiency. Right? Meaning beta, as beta becomes very high, you should measure. What I want to show you now is a different kind of model where actually measuring more, giving more information is not necessarily desirable. Similarly, in the context of intangible investments, we're going to have tangible and intangible investments. Okay. In prior model here, we didn't make any distinction between tangible and intangible investment. We just had one generic investment called mu, and we just measured it with noise. Right? So what I want to show you now is a model where actually you have tangible and intangible investments. It's going to have quite a bit of the flavor we've talked about in this tangible, but there will be essentially a few more ingredients in this model. And let's see how far we go with that kind of a model. So let me lay out the model and push hopefully to full information, and then we'll look at what happens when there are frictions in that model in the afternoon. So here's the model. K, I'm going to call that the firm's level of tangible investments. So now I'm going to get a distinction between tangible and intangible investments, right? Going along some of the things we've talked about here. And N plus gamma is a firm's level of intangible investments. Now, what is the N, what is the gamma? First of all, K is tangible, therefore N plus gamma is intangible investments. So we're going to make a distinction between the two. Right? Before I treated all investment as essentially the same in the prior model. N is the productive component of investments, of intangible investment. And gamma is an unproductive component of intangible investment. Why these two components? Because I want to capture the idea that whenever you make an intangible investment, think of R&D. So think of the intangible investment here as R&D. Think of the tangible investment as property, plant, and equipment, using the language that Mario used earlier, right? PP&E is like your tangible investment. Think of your intangible investment as, let's say, R&D. There's always, whenever you invest in R&D, you know the level of investment, but of course, some of it is productive, it's going to affect future cash flows. Some of it is going to be unproductive. So the unproductive component, I'm going to call that gamma in this model. The productive component is, I'm going to call that N. Now, how do I distinguish between the two? The productive component of both tangible and intangible investment will affect future cash flows. The unproductive won't, right? Because it's just money spent this year and it just affects expenses this year. You may argue, why don't you have an unproductive component associated with tangible investment? I could also do that, but it is less likely that for tangible investment you have unproductive component compared to intangible investment. So that's the spirit in which I don't have any unproductive shock here. I could, right? So I have the unproductive component associated with, so you spend N plus gamma dollars, if you will, on intangible investment. Think of marketing. only N is going to affect future cash flows. If it's marketing expenditures, it would increase your brand name in the future. The gamma is just going to be affecting your operating expenses, has no impact on customer loyalty and future cash flows. That's the spirit of this. Okay? And K is the level of tangible investment. They are both important, however, to affect future cash flows. So I'm going to call that both K and N, the tangible and intangible investment, combine in a certain way to affect the firm's capital stock. Right? Capital stock. So Q is the capital stock of the firm that determines the firm's future cash flows. Right? So this is like a technology that's using tangible and intangible investment and combining them in a certain way to produce output and affect the future cash flows of the firm. Right? So in other words, I want a model that captures how tangible and intangible investment interact together to affect future cash flows. Right? Think of most firms, it's a bundle of tangible and intangible investment combined in a certain way as inputs to affect the firm's future returns. Right? So Q, K, comma, N is capturing that. Now we'll put a structure in Q of K, comma, N later, but for now, we're going to assume that the higher your level of tangible investment, the more productive you are. So Q sub K is positive. Q sub N is also positive. The more the investment in intangibles, the more productive, the higher the capital stock of the firm. And tangible and intangible investments are complements, meaning that the marginal productivity of your tangible investment goes up as you increase the level of intangible investment, and vice versa. So this is positive. So they are complements to produce future cash flows, right? Which seems to make sense. You know, you can also write a model of substitutes, but here the idea is you need both types of inputs in a firm to produce future returns. We need some concavity assumptions to get interior solutions. So I'm going to invoke those. Here are the concavity assumptions I'm going to make. The marginal product of intangible investment is decreasing as you're increasing tangible investment. QKK is negative. QNN is also negative. And QKK times QNN minus QKN squared is positive, right? So think of it as the matrix. The matrix, and you want essentially the matrix, the Hessian of the matrix, right? Essentially, that's the condition on it, right? So these are concavity assumptions that I'm making on the problem. We'll use them later to get interior solutions. But they're not important for now. I'm just invoking them. We'll see exactly where we use them later, right? So that's in terms of the technology. These are the concavity assumptions. And and one technology that satisfies all this assumption is one that's well known to you guys. I'm sure it's the Cobb-Douglas technology, right? So here's an example of that. QKN is equal to K to the power of alpha times N to the power of beta, where alpha plus beta is strictly less than 1. You can verify that it satisfies all these assumptions I've just made, right? Concavity and essentially complementarity and so on, right? Alpha plus beta is less than 1. Of course, alpha is positive, beta is positive. We'll use this special technology when I derive some of the closed forms later on, right? So what is alpha, what is beta? The way you want to think about this is the importance, if you will, of the tangible investment relative to the intangible investment, right? So for example, think of alpha plus beta as fixed. It's below 1. Has to be below 1 for the concavity. If it's fixed, as keeping the sum fixed, as you increase alpha vis-a-vis beta, you're increasing the importance of tangible to intangible investment, and vice versa. If you increase beta, and then of course, if you increase beta, and therefore decrease alpha such that the same sum is constant. These are types of firms in which intangible investment is very important for producing returns. And I'll talk about these later on when we do comparative statics, but something to keep in mind. What is the accounting in here? I haven't told you anything yet. This is just the technology. So here's the sequence of events. This model, 0, 1, 2. 3 dates. At date 0, firm chooses K and N. Remember, we're still in the real effects world. We will be all day. The firm is always making a decision. That decision, the choice of K and Q is going to generate operating profits x1 tilde, x2 tilde. Just like we've been seeing since the morning, right? Very, very similar models. Yes, there's a consistency here in all these models. You generate future returns, operating profits. So x1 tilde, x2 tilde are the, let's call them operating profits generated from your investment. And we'll make an assumption on them. x1 tilde, x2 tilde distributed bivariate normal. Again, for reason that will become obvious just like we did in the morning. Here's the mean, and here's the variance-covariance matrix. So they have the same mean, Q mu, and they have the same variance, x1 and x2, and the covariance is rho. Rho is positive, just like before. Right? Higher values of x1 implies that rho, which is the covariance of x1 tilde, x2 tilde, is strictly positive. There's the persistence in your cash flows. That's what this is capturing here. So date 1 cash flows, in a way, are informative about date 2 cash flows. That's one way of thinking about this. What else? The objective function of the firm. So we're going to assume risk neutrality, which we've been assuming also, but here I'm emphasizing it, of all agents. And insiders, firms insiders, maximize, and you won't be surprised by this objective function, expectation of P tilde, maximize at date 0, expectation of P tilde, max by choice of K, comma N, where P is the date 1 price of the firm. So P is the endogenous price of the firm at date 1. Again, we know what will happen here if you maximize terminal cash flows. We'll derive that. You'll get essentially the efficient level of K and N that you should choose. But what if you maximize P? Well, P depends in turn on the information available to agents in the market, and we're going to study various types of information regimes, right? And see how that in turn is going to affect the firm's choice of K and N ex ante. Question?
What are the elements of the mean vectors?
Oh, that's Q times mu, right? So essentially, Q is the amount of the capital stock that you're producing, and you're multiplying that by mu. Mu is essentially, so the cash flows are x1 tilde. The expectation of x1 tilde is Q times mu. So mu, if you will, is the mean return per unit of capital stock. Right? The reason we're modeling it this way here is because we want to essentially show how tangible and intangible investment together are being combined to affect the expected return. Right? The expected return. So, but they're affecting the expected return through Q, right? Not individually, combined in a certain way. And mu is common knowledge here. So it's unlike the mu. Mu here is essentially common knowledge. The mu is common knowledge. I haven't told you essentially the information set, who knows what yet, but mu is going to be common knowledge. All these parameters are common knowledge. The market knows the distribution of x1 and x2 is bivariate normal. They know rho, they know sigma squared. They essentially also know mu. And, you know, I will also tell you about Q. Yeah?
Changing Q is changing the variance of my profit.
That's right.
We're keeping the risk fixed.
Yes, so changing Q in this model is not changing the variance of the cash flows. That's right. So the variance of the cash flows is fixed at sigma x squared. Yeah. That's a feature of the model. We could bring that in, but in this kind of model, you'll see very shortly, all the insight is coming from forming inferences about future cash flows. So if you're in a different kind of, I mean, if agents were risk averse, for example, then that would matter, right? Because then you might not be willing to choose projects with high Qs because that would result in lower prices. But there's risk neutrality here, therefore, the choice of Q is not going to affect, you know, essentially. We'd then be focusing on the certainty equivalence, right, in these models. Yeah, but that's a good point. That's an assumption we make. It's not going to affect the range. Presumably you could bring that in, see what happens. All right, so that's the objective function, maximizing price. Again, remember in all these models, I'm not telling you where this is coming from. There are various ways to motivate this. You could argue that the current shareholders, this is like an overlapping generations model, whereby the current shareholders all liquidate at date one to a new generation of shareholders. So therefore, they consume P, and the new shareholders pay P. So that's one way of motivating this. Another way of motivating this is the manager, the insiders of the firm are compensated based on prices. Okay, and therefore they care about maximizing the value of the firm at date one. Okay? Again, I'm taking this as given, that there's no optimal contract or anything else. They care about maximizing the price of the firm. The third thing you could argue here is that the manager cares about maximizing P for various reasons, takeover pressure or whatever, right? But all that matters here now is, as you can see, that once you bring in P, you don't care about terminal cash flows, then how P is formed matters. And P is going to basically depend on the information set available to the market. What is the information available to the market? How are prices being determined? That's essentially where we're going. Okay, so then the cash flows at, so what is P? Just to put some structure on it, is going to be essentially x1 tilde minus k minus n plus gamma. And I'll explain what that means in a second. Plus expectation of x2 given phi1. Right? Now where phi1 is the information set of the market at date 1. Now what is P1? Look at P, the form of P. At date 1, X1 has been realized, minus the investment in tangible, minus the tangible investment, minus the intangible investment. So if this, if you will, is the net cash flows at date 1, right? Plus, and that's been realized, plus the market is going to form beliefs about X2 given the information set that they have, which is phi1 here. Now I have to tell you what the market knows at date 1, but essentially that's the price, right? So essentially the price of the firm is, the market is pricing the current cash flows, net cash flows, net because net of the investments, intangible, intangible, plus the expectation of future cash flows, of future returns, future profits. So very similar to the model we had in the morning, the one earlier, if you will. P is equal to, there it was Z1, if you remember Z1, plus expectation of X2 given the information of the market. And risk neutral pricing, I'm not discounting for risk, as I've said earlier. Right? I've said earlier. So in a way, prices is capturing all the returns, current returns and expected future returns. So what are we studying in, what is phi1? What is the information systems we are studying? We're going to study two regimes. So we will study two accounting systems or measurement regimes. I'm going to call one regime where I'll call that the expensing regime. And the other one I'll call it the measurement regime. And let me explain what is the expensing regime, what is the measurement regime. In the expensing regime, there is no attempt to measure intangibles. Right? There's intangible investments. Intangible investments are commingled with operating profits, or operating cash flows, if you want to call it that. There's no attempt whatsoever to measure intangible investment, the n plus gamma. Just expense the whole thing, leave it there. We're not going to measure it at all. That's what we're calling an expensing regime. It left commingle with and I'll give you the structure of the, I'll put some structure on this very shortly to show you what this means. But there's no attempt at all to measure intangibles. Whatever you spent, you leave it commingle with your operating expenses. Okay? In the measurement regime, you try to measure this the accounting system provides a report on the level of intangible investments.
As though it were capitalized?
Say that again?
As though it were capitalized?
Yeah, as though it was capitalized. You can view it that way. Though capitalized in accounting we know means that you recognize it as an asset, you put it on the balance sheet. You can view it that way, but here we're not going to talk about a balance sheet versus necessarily. So think of it as think of the measurement regime and expensing as follows. If you spend money on marketing, expensing means that all the marketing expenses are essentially on the income statement commingled with other components of SG&A. Right? That's expensing. Commingled with other components of SG&A. You're not separating it. If you were to measure marketing expenses, so the measurement regime would say that measure the level of marketing expenses separately from other SG&A components and show it. So it's like R&D is right now on the income statement of a company. You could argue, is a measurement regime for R&D. It's not on the balance sheet, right? It is on the income statement as a separate line item, right? You do disclose, firms do disclose R&D. Imagine a world in which you did not, you basically commingled it with other expenses. That's the way. And I'll show you the structure of this, right? But you can view it as capitalizing, because capitalizing would mean that you are separating it and producing a report on the level of intangible expenses, investments. Okay? So we're going to study the consequences of doing 1 versus 2 now. Think of it this way. The model I showed you earlier, measuring is always good. I showed you that measuring the accruals is always good. You should measure. Measurement always dominates not measuring the model in the morning. What I want to discuss in this model is that always true whenever you have tangible and intangible investments? Right? What are the trade-off of measuring versus expensing? And I will show actually there's going to be a trade-off. You may not always want to measure. Sometimes you want to actually, for some types of intangibles, you may want to leave it commingled with other type of investments. You may say, why? How does this happen? Because I will show you that by measuring, you may be making errors, and essentially the errors you're making in measurement may be so high that these errors overwhelm not measuring, leaving everything as expense. Again, you won't get this insight if you do not focus on real effects. Right? But here you will get that insight because I'll show you that measurement may essentially change your incentives in such a way that you essentially may distort the level of tangible and intangible investments, right? So what are the, a few more minutes is okay? Yeah? So let me essentially put the two information systems before we break. We take a break for lunch. Put some more structure on this. So here is the expensing regime. And here's the measurement regime. So in the expensing regime, you have essentially a report on the tangible investment. Okay? You have, so think of this as the balance sheet. You have an income statement report, which is essentially Y. I'm going to call that Y sub E, which is essentially Z sub E plus K. I'll explain what this is very shortly. This is x1 tilde minus n plus gamma. And then you have like the statement of cash flows, which is Z sub E, which is x1 minus k minus n plus gamma. This is the expensing regime. Let me explain this. So in the expensing regime, you do not measure intangibles at all. You don't even try, which means it's less commingled with your operating expenses and operating your revenues and so on. So that's why here's your cash flows. That's ZE. That's x1 minus investment intangible minus tangible investment minus intangible investments. Right? But you do measure the tangible investment. Therefore, your income statement, you have your statement of cash flows plus the measurement of your tangible investment K. You get x1 tilde minus n plus gamma. Right? So that's your expensing regime. It's expensing in the sense that there is no attempt to measure n plus gamma at all. It's left commingled with your other expenses, right? And that's YE, and here's your ZE, right? Of course, one of these signals now is redundant because if I take I sub K, add it to ZE, I get Y sub E, right? That's why Y sub E is ZE plus K, right? So that's what we call the expensing regime. You're not, again, attempting to measure intangible investments at all, right? It's essentially here as cash, and it's also left commingled with other expenses on your income statement. You can break X1 into revenues minus expenses if you want, but the idea is everything, all your expenses here are commingled, right? And here is the intangible investment. Now, what is the measurement regime? To compare the two. In a measurement regime, you will try to measure so you have a balance sheet, you have I sub K, I sub N. Now you'll try to measure your intangible investments, and then you'll have your income statement, and then you'll have your statement of cash flows. So let me again write the income statement would be X1 Z. Okay, just a second here. So let me explain what's going on here in the measurement regime and compare it then with the expensing regime. So the only difference between expensing and measurement regime is that you're going to try now to attempt to measure n plus gamma. Okay? And therefore I have a report called I sub n because I'm measuring the intangibles. I don't have it here. Here only measuring the tangible investment. So I measure it, that's the n plus gamma. But in doing so I make two noises, two mistakes. That's omega and eta, right? I'm going to explain each one of these. So the mistake about omega is in trying to measure the intangible investment, I'm essentially going to make mistakes separating intangible investment from operating expenses. That's omega. So omega is essentially measurement errors in separating intangible investments from operating expenses. Right? I gave the example earlier of R&D. If I'm trying to separate R&D, let's say, from other type of investments, I'll make mistakes in essentially separating R&D that truly is going to affect my future cash flows from operating expenses that won't. And that's what I'm calling omega here. It's not present here because I'm not even measuring it. It's left commingled with expenses. Once I try to separate it out, I'll make a mistake. That's what I mean by omega. Now, if I make a mistake here, if I essentially overstate my intangibles, I'm going to overstate my earnings. And you can see it right here because every time I overstate my intangible investment, in other words, omega W is positive, that means that I'm going to overstate my earnings, right? Because my earnings is my net cash flows, and I add back my measured investments, IK plus IN. So here I'm adding back the IN. In a minute, I'll show you that you'll get omega. So that's the first mistake. That's the first error I make. Why is this an important error? In my mind, this is one of the biggest, controversies around measuring intangible investments. Insiders may have either good intentions, they still make mistakes because they cannot truly separate what is truly affecting your expenses this period versus affecting your future cash flows. That's captured by the omega, right? There's a fine line between what an intangible investment that is affecting your current cash flows versus your future cash flows. That's captured by omega, or W here. I'm saying omega, W. Let's call it W. Okay? So that's the first mistake. The second mistake I make here is in trying to measure my intangible investments, I'm actually also now going to figure out how much of it is tangible, how much of it is intangible. And that's captured by eta. Eta is the mistake in trying to figure out what is a tangible investment, what is an intangible investment. Again, I don't have it here, but I have it here because in trying to separate my tangible and intangible investments, I may actually make a mistake. If I understate my intangible investment, I will overstate my tangible investments. That's the minus eta plus eta here. Right? So eta is a measurement error in separating tangible versus intangible investments. Now, this is an important one to think about, right? This one is easy to understand. You may say, why don't you have it here? Because you also here are measuring your tangible investment. The reason is the following. Think of this model here as there's no attempt whatsoever in measuring intangible investments. So actually your measurement of tangible investment is very conservative. Here, when in doubt, you're expensing all your intangible investments, right? Which means that your tangible investment, one way of thinking about it is actually think of it as you are in your expensing regime, whenever you measure IK, you're actually saying that IK is really less than, K is your true level of investment, right? So in a way, you're understating even IK here, although we're making it equal to K. But all that you're saying here is that your level of K is greater than or equal to IK. That's one way of thinking about the expensing regime, right? When in doubt here, you're expensing. So every time you produce a level of even tangible investment of IK, you're saying that your level of tangible investment is at least greater than that, right? But we are making it here for simplicity equal to K. Here you're very liberal in your measurement, right? That's why it's called a measurement regime. You're saying that we're going to measure intangible investments, but in doing so, you're actually making mistakes in your intangible investments. You're not understating it. Think of this here as being understating it, but for simplicity, we're saying that your IK is equal to K, right? That's a modeling device. But here, it's actually separating your tangible, intangible investment. You're making two mistakes. So not only are you making a mistake in separating intangible investment from operating expenses, you're also now commingling your tangible investments with your intangible investment. Think of PP&E, which is your tangible investment. In a way, you're saying, in this model, you're saying that I don't know how much of my PP&E is going to be used for innovative activities, right, versus in R&D investments versus used in my operations. So that's where the eta is coming from. So there are two mistakes you are making in the measurement regime. In the expensing regime, of course, you're leaving your intangible investment commingled with your operating expenses, right? So essentially, that's, so again, what we're trying to do in this model here is to stay true to what accountants face, right? If you want to model these accruals and these measurement errors, you essentially have to figure out what are the type of mistakes you'll make in separating intangibles. And here we're showing that typically in practice, there are two mistakes that you're making. One of them is you're truly making mistakes in separating intangible investment from operating expenses, but also you're making mistakes in calling in intangible assets tangible or vice versa. Here you're not making that mistakes in the expensing regime because all your intangible investments are left, essentially on your income statement. There's no attempt whatsoever to measure them. I think I should stop for lunch.